All right. 11 o'clock Texas time sharp here, it looks like. So, all right. So welcome to everybody. I know folks will continue to trickle in here and give them a couple of seconds, but maybe we can start with the introduction. So I'm Tim Kelly, one of the owners and founders of T&T Dental. And we are a marketing company for dental practices. 25 years we've been doing it. And I spend a lot of my time during the day talking, of course, to my clients, but also to potential new customers. And over time, you get a lot of questions about a lot of different things. And one of the topics that's just over the past 15, 20 years that's just gotten more and more dominant is transitions and DSOs and the consolidation in dentistry. And so as we've talked to our customers about this over the years, we've gotten to know a lot of players in the industry, and we want to understand the situation and be able to provide good information to our customers as well. So today, we're very, very excited to be joined by Ty Ramsey and Matt Zolfo from Professional Transition Strategies, who are experts in the area. And it's interesting, before I turn it over to you guys for a quick introduction, I saw on our invitation that we sent out, it actually says our host and the guest panelists have been directly involved in more than 1,000 practice transitions. And that made me laugh. It made me think of, if you really want to be honest, it's like saying that me and Michael Jordan together have 6 national championships. Because I'm the ones that done it. So that was pretty poorly worded there. I've been involved in talking about them with my customers, but I sure haven't been involved in doing it. So in all seriousness, I couldn't be more thrilled. I think everybody's going to get a lot of great information out of this. So before we get into some of the questions I want to ask, tell us a little bit about yourselves and your company. Ty, let's start with you.
Yeah, so I've been in the dental industry for a little over 20 years. Started with a company called OrthoCAD that really dates me. That at the time they digitized stone models and made the digital version and shipped it back to the doctor. From there, I moved in. The majority of my career in dental had been in capital equipment sales, namely cone beam sales. I was a national ICAT rep for about 13 years. Had the opportunity to sell over 800 ICATs in my career and got to be first name basis with a lot of the top practitioners in the world. And that's where I met Matt too. Matt Henry Schein was an exclusive distributor of ICAT for many years. And I met Matt there, and Matt probably wouldn't say this, so I will, but Matt was a tremendous career at Henry Schein. And if I'm not mistaken, I think he's built more new offices than any rep anywhere in the history of Schein anywhere. So Matt has a wealth of experience as well. And we just kind of crossed paths and worked together for many, many years. And we always joked, hey, one day we'll probably work together. And here we are. So I'll let Matt tell his story.
Amen. Yeah, no, I'm honored to call Ty not just a coworker, but a close friend. So dental business has been real good to me. Actually, our founder and president at PTS, Professional Transition Strategies, and I knew each other at Baylor from the time we were about 19. So similarly with Kyle, proud to be his employee, but also call him a very good friend. I started at Henry Schein by the grace of God in equipment and business development at 21 years old in 2004. So coming up on 20 plus years in the business. I was there almost 15 years, did 847 startups, moved over to a healthcare technology firm called Simplify, attempted to get enterprise off the ground with them through the capital raise and things of that nature. And ultimately, just before COVID, moved over to PTS for M&A. So had the great privilege and joy of helping many, many people not just start their first practices, but in some cases a second or a third or a 30th or a 50th or an 82nd based on, the groups I was working with, and now really have the privilege to be on the M&A side for sell side representation, hoping those folks preserve their legacy, leverage that equity in a new environment, or throw the keys in the mailbox and move on to retirement. So it's meaningful work, it's fun work, it's challenging work, but have been real fortunate to be in this industry here for what was 20 years and hopefully 20 more to come.
Yeah, good for you. Those are two awesome resumes, and I guess that illustrates why we got you on here, because you guys know the information, and let's get to it. One thing I'll say, you guys had mentioned that you've got an offer that we want to be able to give to the folks at the end. We'll put up a slide, and you guys can talk about that. So don't let me forget to talk to that.
If I could just jump in real quick,
Sure,
one other thing. One thing I wanted to add that I think is unique about Matt and me is, we got a lot of enjoyment in our previous careers for helping. In my case, it was helping the doctor. It was probably the largest capital expenditure he had ever made. Just a single capital for $100,000 plus cone beam machine. And in Matt's case, it was the largest investment in the doctor's self that he or she had ever made in building their practice. So understandably, Matt and I got very close with these doctors, almost like family. So then getting into the transition space and now being able, really what is now even a bigger decision for them, we're on the front row seat of that, being a good shepherd for them, helping them make the biggest decision of their life. So our careers have kind of just come together in this perfect storm where now we work together to basically help doctors create generational wealth for their families and get value for their life's work. So it's a good situation.
Yeah, rewarding job, and a great way to. I love the perspective that you've got there on that, because that is what it is. It is one of the biggest decisions they'll make. It's their life's work, and good for you for thinking of it in that way. And again, I talk to doctors all day long, and I would say probably the biggest question that they have is, how do I know how much value is in my practice? How do I value my practice? I mean, because sometimes I think maybe you have an idea in your mind of how much your practice is worth, and maybe it's accurate, maybe it's not. So what kind of goes into that? How do you guys value practices, and tell us a little bit about that process when you're trying to value one?
Yeah, for sure. So it is a fairly complex methodology, and historically no different than any other asset. A piece of equipment, a home, a car, an asset is worth what a willing buyer and willing seller can agree upon. And the sample set of market comps, right? Market comparables are basically what quote unquote make the market. So to that effect, more broadly, historically for, as long as I've known, call it 70, 80, 100 years, dental practices have been undervalued. Contrary to other businesses, if you owned a dental toothbrush manufacturer or a dental software company, the parts would usually be interchangeable with new ownership. So the lens with which a buyer or a businessman or woman or an investor would view that valuation is different than, say, a doctor to a doctor. But historically, that's been based on a percentage of collections, the type of dentistry the practice is doing, the location, the top line collections, the patient numbers and demographics, the technology in the business. Those are all very tangible things historically that have lent itself to evaluation. And now nowadays most doctor to doctors transactions are still weighed in that amount. We at PTS have a fairly sophisticated methodology of ratios based on population demand in that area, growth in that area, obviously collections, work back for the doctor. All those historically have gone into evaluation that tends to line up somewhere between, call it 70 to 95% of collections, right? Whether it's plus or minus that $1 million mark, number of providers, number of hygienists, associates, things of that nature. On the contrary, as dentistry's been consolidated and a fairly shrinking number of providers wanting to own their own practice, and a fairly growing number of groups in organized dentistry tend to value that based on a term called EBITDA. which basically, very practically, if you think about it, EBITDA is what's left over after you pay all of the expenses and a fair doctor's wage to do the work. So if that doctor owner owned the business, but what wasn't in the business with their two hands, EBITDA is basically the margin of what would be left over. And nowadays, in an investor transaction or a group transaction, practices are valued on a multiple of that, right? Historically, valuations in the dental industry have been capped or inhibited based on what's called a lending ceiling, which is set by lenders. Invariably, different than a toothbrush factory or a software company. One doctor invariably goes away and a new doctor comes along, and a good amount of the value there is the relationship that doctor or the presence that doctor has in the community. So if you insert a new owner, the fear from a lending standpoint is that a lot of that goodwill goes away. So most lenders, the bigger lenders, tend to cap valuations at 80 to 90% of collections. The smaller regional lenders are a little more flexible in that regard, knowing that in major MSA markets, call it the top 50 markets in the country, practices tend to trade closer to that 90 to 100% of collections range. So probably TMI on the valuation component, but that's what's comprised of it. And it really depends on what route or trajectory the seller wants, be it somebody coming in and then walking away, or really plugging into a strategic partner or financial partner that can continue growth and over the course of time end up in a new stage of their career.
Yeah.
Did
you want to add something to that?
Yeah, I'll just add on, when Matt was talking about, multiple of the EBITDA, perhaps the dentist watching or thinking, how does that compare if I sold to another doctor? Well, I'll use an example of a pretty good practice with a good margin. So let's say we have a $2 million practice with 500,000 of EBITDA. Now, in the traditional doctor-to-doctor market, that practice is going to go, let's just call it 80% of collections. So let's say 1.6 million is the market value of a practice. And by the way, the bank ceilings determine the market value. So because of banks, dental offices have been historically way undervalued. Well, then in comes private equity. So they pay on multiples of EBITDA. So that same practice, and I'm using a fairly conservative multiple here, let's say a 6x EBITDA multiple. So that would garner a $3 million valuation. Now, they might get $2 million cash at close and then $1 million in the internal stock or group equity in the group. So imagine as a dentist, instead of owning 100% of your one practice, you now own 1% of 100 practices. And as those scale and grow together, and they centralize the back office. So on day one, their office is worth exponentially more than it was on an individual basis. So that group stock historically has far outperformed the stock market. On average, that group stock grows about 3x every 3 years or 5x every 5 years. And that's not pie in the sky numbers. That's everyday averages over multiple industries with these private equity funds. So in that same scenario in which the doctor had a $1.6 million practice doctor to doctor, he's getting $2 million cash at close and $1 million equity in the group. Now let's fast forward 5 years. On average, again, on just average, that equity is going to be worth $5 million. So we've just he got $2 million cash at close, which is already better than he was going to do. And then his equity in 5 years is worth $5 million. So we just turned a $1.6 million practice into a $7 million wealth accumulation. And that does not include the fair doctor wage that the doctor would be paid as he works back. Normally these groups want a 3 to 5 year work back, which means basically an employment contract for the doctor. But that's what a lot of doctors just don't realize, is just the amount, especially if they're even thinking about an exit plan at some point. The time is plan ahead. What you don't want to do is be, hey, here's the keys, I'm heading to the beach, sell this for me. You want to plan ahead so that you can take advantage of this consolidation wave that is inevitable in the industry.
Wow. That's a huge difference. I mean, between the two strategies there. So does a DSO then always provide the highest valuation, or are there any other strategies that transition strategies where you could get anywhere close to that, or is that almost always the best valuation?
Great question. I mean, keep in mind, the answer to that is it depends, right? The whole function of what Ty was referencing of this multiple of EBITDA that everybody's been talking about for 12 to 15 years is a year of earnings, right? Yep. So whether it's, 4 or 5 or 6 or 7 or 8 years of earnings that you're getting up front in some form of structure, right? The whole concept is that, the group as a whole is more value than the sum of its parts individually, right? It's math, candidly. So, historically, groups will value practices more because they're looking at that from an investment standpoint. As a footnote, no one should partner or plug into any group that they don't like and that they don't trust. So that's a big part of our process. The dollars are going to be there, whether someone works 15 more years. Well, in theory, that's 15 times EBITDA, right? Yep. And, throws the keys in the mailbox and gets 0 for the practice. Well, if you can garnish some of that value early and or, leverage that equity that you have in your current practice as an investment vehicle in a new environment, then maybe it's worth considering. So, to that point, this whole concept is referred to as what's called equity arbitrage, which basically means the equity that you have of your, one share of ownership in your one practice, in theory, will grow faster and candidly, in most cases, tax-free in a new environment. Ty's 3 to 5 times return on invested capital analogy over, call it 3, 4, 5 years, ends up being something like an appreciation in value of about 80% year over year. Well, can you grow your own practice 80% year over year with your own 2 hands, right? And the answer is maybe, right? Or your own organization, maybe. But, ultimately, from a value standpoint, this environment did not exist 15 years ago, and it will not exist 3 to 5 years from now. And I mean that. If you look at the biggest players in the space, have had 3, 4, in some cases, 2 liquidity events. Unless that group is growing and that organization's value is appreciating, at some point, the majority of the MPI numbers in dentistry will hit an endpoint, and 30 to 40% of doctors will own their own practice, and they'll transact it at a percentage of collections. So that's not 10 years from now. I hope it's 7 years from now, right? Yeah. I'm 42 and need to work 10, 15, 20 more years. So it is definitely in all of our benefit for that to be prolonged. But from a value standpoint, to your point, Tim, the short answer is, it depends. It really depends on who the buyer is.
Yeah. And talk to me if you can, because we talked about this a little bit, some of the structures of are they all the same, or are there different ways that this, Ty, go ahead. I see you.
Yeah. There's all kinds of different structures and all kinds of different options for the doctor. With the first being, traditionally what doctors have thought of as a DSO. DSO is a 4-letter word to a lot of people, and it earned that reputation to some respect, but that was more of the original DSO model, and those still exist, and they can still be successful, but those just aren't the kind of groups that we work with. But that traditional model would involve a doctor basically selling 100% of his practice to a DSO. He has no equity. He then steps in as employee number 1837. He's using the materials they want him to use. The practice is more than likely renamed. He's just he's just an employee. So and that works for some people, but that's how DSOs, I would say, in general, that's how they're thought of by the people who haven't done the research on what all the options are out there. And then another option is, like we've already discussed, sell to another doctor. And then there's in in the private equity world, there are multiple options as well. One, a very popular one nowadays, is called a joint venture. And that is a situation where the doctor, for instance, might do a 60-40 joint venture in which he sells 60% of his practice to the DSO and retains 40% ownership. That means that he retains clinical control of the practice. He makes all the decisions clinically. He gets to use the materials he wants to use. He gets to keep his same staff at the same wages or higher. His name stays on the door. No one would know he sold to a DSO. But he's taking advantages of the group economies of scale, best practices across hundreds of practices, and being able to use that real-time data to help grow his practice. So it is a joint venture because he's still incented very much to grow because he or she are getting 40% of the profits. And then there's another popular structure called an equity roll. Now that's could be the same scenario, but instead of the retained practice equity, the doctor gets equity in the whole group. So that would be a situation which the doctor sold, let's say it might be a 70-30 equity roll. That would be a situation in which the doctor sold 70, he sold 100% of his practice, but he got paid 70% in cash up front and then got 30% of equity in the group stock. So again, back to my original reference, instead of owning 1% of his or her current practice, they now are 100% of their one practice. They now own 1% of 100 practices. So those practices together grow exponentially more and higher than an individual practice. So that's another option. And then there's another option called a sub DSO. Now, this is for the entrepreneurial minded. They might already have 6 or 7 practices that are mainly associate driven that they've built. And there's an opportunity sometimes for them to roll into an existing DSO and create their own entity within that while still enjoying the advantages of the group. And then there's even another in that same scenario. If the doctor has grown their individual group big enough, it warrants taking them direct to private equity, where they would basically start their own DSO. And I know Matt's done a couple of these, and I've currently got a client that we're doing the same thing, and it's going to be, north of $100 million deal. So PTS works on every practice all the way from, Dr. Smith, who's 70 years old and wants to retire tomorrow and go to the beach. So this practice is doing $750,000 all the way up to the 40, 50, $60 million entities that want to explore the private equity market.
Wow. Just hearing you describe all of that, it just, as it's evolved over these years, all these different structures and options now, it just continues. The structures continue to evolve, and a lot of them in favor, it sounds like to me, of the doctor. I mean, these are good. These all sound wonderful to me.
Yeah. Well, what private equity figured out, we probably don't have time on this lecture to go into it, but private equity, if you want to really dumb it down, it's private equity investors are some of the smartest financial people in the world. They know how to make money, and they figured out really quick in dentistry. The exciting thing for me in this, being in dentistry and this consolidation, what do you think when you think of consolidation in other industries? You think of stuff going corporate, and once they go corporate, the quality of care or the product goes down. Well, and that could be the case in dentistry in some cases, in some of those activist groups that we talked about. But we work with 375 DSOs, and I would say well over 100 of them are doctor owned and doctor led, and the new breed of DSOs. So those are the ones that we work with, and it's private equity does not want. They figured out real early they don't want to come in and tip over the apple cart. The best thing they can do is have a happy doctor. It's actually called the happy doctor concept. A happy Dr. Smith is going to do this. A controlled, angry Dr. Smith is going to do this. So they're on your team. It's not a, hey, we're big bad corporate and you're our employee. As a matter of fact, it's quite the opposite.
Yeah, interesting. All right, so Matt, I'll switch back to you for a minute. You've got all this. You gave us your resume earlier, which is impressive. So use your crystal ball with all of your knowledge in the background and look out 10 years from now and say 2035, because we've had a lot of this consolidation's already taken place. I don't know how much is left. You guys have a better perspective on that.
Yeah.
What's dentistry going to look like 2035?
Boy, if I had a crystal ball, I wouldn't be, helping doctors transact practices. I can assure you that. But I can tell you facts. And the facts are, if you look at a time horizon, of, thing one, an industry can only consolidate once, right? Yeah. Hospitals consolidated, pharmacies consolidated, dermatology's consolidated, optometry/ophthalmology consolidated. Right now, dentistry, at least in the realm of multi-site healthcare, is the highest demand healthcare, retail healthcare vertical being consolidated. We're already in aesthetics. We launched LuxMed earlier this year, late last year, and we're already in plastic surgery. So we're preparing for that endpoint in dentistry. Now, all that to say, let's talk about what that looks like, right? If you Google literally Harvard Business Review, equity arbitrage, consolidation, healthcare, that'll take you to an article written a couple years ago about what's called the valuation bell curve. And invariably, groups will always want to, acquire or partner with a good doctor and a profitable business and a growing business that they can add value to, right? That value in the organization doesn't go up either in share price or in multiple of joint venture equity transacted without being accretive, right? So all that aside, it's really a numbers thing. If you look at the number of NPI numbers in dentistry, there's about 194,000 NPI numbers in the country. Yep. About something like 40 to 50,000 of those are specialty. Of that, call it 200,000 NPI numbers assigned to dentists. About 20% of them are deceased. And we know that as of about last year, we're at something like 38% consolidation in the GP world and likely over 40% consolidation in the specialty world. Now, why specialty higher than GP? Well, there's fewer of them, right? You've got, something like 35 to 40,000 practicing specialists across the country. And as these liquidity events have occurred, where a small cap fund transacts with a mid cap fund transacts with a large cap fund transacts with an even bigger large cap fund. Those are what are called equity cycles. Most of these other industries, hospital 40 years ago, pharmacy 30 years ago, dermatology 10 years ago, vet about 5 years ago, had varying time horizons that they were consolidated based on the number of providers, right? So vet was like super fast, 5 to 7 years. Hospital took 30 years. Right? Dentistry is going to be about 15 years. And it's just because of the function of the number of providers that are willing to partner with a group. So some won't participate, call it, 30, 35, 40% of providers won't partner their practice because they want to own their own. And if you fast forward 10 years from now, a new grad out of dental school will still be able to hang a shingle and start a practice. When I resigned from Henry Schein about 7-8 years ago, the budget that we do on a startup was $575,000. Well, post-COVID, post-inflation, now with labor rates increasing, you look at the amount of hygienists that exited dentistry, just what overall things cost to do that in a major MSA, you're looking at about $1 million, right? So the number of people starting those practices will be fewer and far between just based on the profile of the dental school graduate as well as the cost mechanism. So invariably, what's happened over the timeline of these liquidity events is that market valuations have been a bell curve, right? So they started out at 70, 80% of collections. We believe that right now we're at a peak, candidly. And we didn't talk like that last year. We didn't talk like that the year before. But, we do about 75 to 100 transactions a year at PTS. Well, more than half of those are doctor to group. The other are doctor to doctor. And we get something like 5 to 7 LOIs in every deal. So, I mean, if we just go with an average of 100, what's 100 times 6, right? Well, that's 600 LOIs. So our sample set of what the market's willing to pay in every time zone, we've got inventory in all 4 time zones. It is pretty vast. And, every year after COVID, valuations increased or multiples increased. The last year or two, that has not been the case. We've still done as many deals. There were some groups that, were not accretive and worked on, buttoning up the current partners that they had and were adding. And there are others that were and did very, very well because, they were able to add partners. So we think in this current environment, post-election, post-interest rates coming down, if you look at any of the M&A outlook nationally in the United States for 2025, it's very, very bullish. How long that'll last, if you just look at, the amount of equity cycles that have happened, 2, 3, hopefully 4 more years, I think we'll start to see a decline in some of those valuations. Now, again, that's not to say a doctor can't partner with a group then. However, if, no different than in the event you bought Facebook or Netflix or Google or GE at $1 a share, and now it's, $300 a share, the sooner you get in with that assistance and, that help of a partner, the longer time horizon you have for that equity to grow. So, I think the sweet spot right now is if anybody's going to work more than 15, 20 years now in owning your practice, don't do it, right? In theory, back to my multiple of EBITDA example, right? EBITDA is a year of earnings. So if you've got 15, 20 more years of earnings, great, hang on to it. Keep doing what you're doing. However, if that time horizon is 3 or 5 or 7 or 10 or 12 years, this makes sense. Just because you've got the time horizon now for 1, maybe 2 more liquidity events. But, after that, the overall market valuations of practices will be back to more alongside the doctor valuation.
Interesting. Very interesting. Ty, you have anything you want to add to that? I mean, is that
He pretty much covered it all.
It looks like 10 years. Yeah.
Yeah.
Again, I hope it's 10. Don't get me wrong. I've got a 14-year-old going on 21 and a 12-year-old going on 16. So, I'm hoping it's not 3 or 4 years, but,
Well, interestingly, you've already identified other industries where it's in a different stage, and I've been in dentistry so long I don't even think about other industries so much, and it's just interesting to hear you talk about what's happened in the past and what's going to happen in the future, and how much time we've got left here to go through this cycle.
I do have one thing to add. I just thought of it. For doctors that, aren't even considering looking into this, I would encourage them just to look into it, just mainly because your competition at an increasing rate is going to be joining these groups. So what that means to you is that, Smith Dentistry versus Jones Dentistry. Jones Dentistry joins a DSO. Jones Dentistry is still Jones Dentistry. No one knows that they joined the DSO, but now Jones Dentistry is getting all their supplies and equipment at half of what Smith Dentistry is. So it's going to, unfortunately, fortunately, however you want to look at it, be harder and harder for the privately held dentist to compete. Now, that's not to say I'm not discouraging anyone from not doing that, but just that's the lay of the land moving forward. It is going to be harder and harder for the private dentist to compete because there's going to be a groundswell of dentists that appear private that have partnered with a DSO.
Yeah, and it's interesting. Part of what I do with my customers, I lead our new site team, and part of what we do on that is talk about the story of the practice. And when I've got a private practice customer, oftentimes what they want to say of their story is that, that to them, that's a competitive advantage. We're a private practice where, because I think, and you hit on this, Diet, both of you did at the very beginning, is those early structures and to some extent DSOs have earned their reputation that was negative in the beginning, but it has changed a lot over the years. And so I don't necessarily think of it that way anymore. And I know our doctors have questions about that. Are there types of structures that you've described so far that are run better than others that in your mind, and do you care to name any names of the best run DSOs in the country? Or, Tell me a little bit about that, because I do think it's changed over the years.
Yeah. I could probably give you at least my take on that, and Ty would love yours as well. But, if you look at the big bad wolf perception of quote unquote DSOs, right?
Yeah.
The ones that really earned that reputation are not clinically agnostic. They're clinically directive. And on top of that, most of those groups don't do acquisitions. They do de novos. If you sort descending the top 10 quote unquote DSOs in the country, about half of them don't buy practices. If they do, give us a call. We got a ton of inventory. We'd love to work with you. But they plant a flag, right? They set up 8, 10, 12 operatories, and then they hire new grads out of dental school and tell them what the treatment planning protocols are and clinical protocols are, because 68, 70% of the United States population has periodontal disease, right? That's not your typical group anymore. It was years ago. But, no different than patients, you get 1 or 2 bad patient referrals, it's really going to impact your practice. Well, you get 1 or 2 bad partners, whether it's a bad actor from a partner standpoint or a group treating a partner poorly or illy, you're going to know about it, right? You're going to find out about it. So luckily, I'm grateful and certainly, glad that that's not the case now with most groups. And by most, I mean, Ty said, 100 of about 375. I would wager that 50, 60, 70% of them now are clinically agnostic. So making sure that you're plugging into something that is what they say they are and is valued at what the market would bear. All of these things tie through to representation. So, at the risk of sounding wildly arrogant, anybody that thinks they can go at this on their own and plug into a group without representation is crazy. I mean, if you just think of simple math, as a fiduciary for a fund, if a group is private equity backed, they have a fiduciary responsibility to their investors, LPs in the private equity fund, to acquire a practice for, the lowest possible valuation they can get. And that's not to say that there's, any bad actors there, that anything, is being handled poorly. It's just that, an asset is worth what a buyer and seller can agree upon. So, whether it's us or any other advisor, making sure that A, you're casting a wide net, B, you have a chance to talk to doctor partners, C, you understand how equity is valued, where it's going to live, whether it's at the practice or at the holding company. There's different classes of shares. I mean, I'm really proud of, on average of our about 100 deals a year, that we regularly have something like 50 to 60 different buyers in that transaction, and no 2 of them are the same. They may have some iteration of a legal document that an M&A lawyer drafted for them, but they're all different. So making sure that you know the terrain before you navigate it, if you are looking at making a life decision here, that's really, really important. So, I'd like to think that the majority of them are definitely good actors. There's certainly some bad eggs out there, just like there's good CPAs and bad CPAs, and good lawyers and bad lawyers, and good dentists and not so great dentists. But broadly making sure that A, the group's being accretive and that, there's growth to that equity value. And then B, that, they're clinically agnostic is certainly 2 kind of key factors that our clients take into account, and that we walk them through soup to nuts from beginning to end.
Awesome. Yeah. And to add to that, they're just like, let's face it, there are good dentists and bad dentists. So just like that, there are good DSOs and bad DSOs. And I wanted to applaud Jonathan for a great thought here in the chat. I'm actually going to read it and then answer it. He says he challenges the thought, that thought. He said he's seen many practice conversions, and the practice does change. The selling dentist is transitioning out. The quality of the associates decreases. The clinical work decreases. This is only a benefit for private practice owners, because patients are leaving the practices taken over by any form of corporate, big corporate, small corporate. I'm interviewing dentists every week, and no associate has anything good to say about corporate. And Johnson, I got to say, I 100% agree with that. And I would be willing, and I'm happy to chat offline, but I'm guessing, or I'd bet a lot of money probably that most of those dentists you're talking to are the ones that have been involved with the activist groups, is what we call them. Those are the ones that the dentist becomes just an employee, and he is transitioning out. And that the average tenure for a dentist in those groups is about 18 months. Well, those aren't the groups we work with. We work with doctor-owned, doctor-led groups, and these dentists have partnered with them knowing that they're going to work 5 years or more. So they're not transitioning out in any way. So there's a whole new world out there that a lot of dentists, maybe yourself included, don't know about. That's the world we're in.
Yeah, interesting. And appreciate you grabbing that too. And in fact, I should probably say that if we're getting close to time here, and we'll try to get back with answering questions, even if we don't get to them during the program here. We'll try to get everybody answered if you have additional questions. Maybe one last one here. I do talk to a fair number of dentists who maybe they own 1 or 2 or 3 practices now, and it is their goal to kind of start their own. What advice would you give them? Is there a few bullet points I can pass along to them if they're looking to start their own DSO that you guys would give as the experts here and seeing enough of this?
Yeah, for sure. Well, if they're doing that as a means of A, serving a community, but B, increasing, their overall earnings and/or net wealth, the one bullet would be hurry. I did a lot of practices over the years, and the joke used to be 1 is easy, 2 is challenging, 3 is make or break. If you can get to 3, you can do 10. I don't know that that's really the case anymore with, staffing challenges and stuff like that, but it was 15, 20 years ago. And, the caveat there is as you grow and add locations, the demands of your time as an owner become thinner, right? So you end up having to pick what to focus on. So, in theory, one doctor can work out of 2 practices and you can have auxiliaries work both. But once you get to 3, you're dealing with other associates. You likely have repetitive tasks that are done at each location that you can centralize and stuff like that. So, broadly, more practices doesn't necessarily mean more value. More practices certainly does not mean more EBITDA. It means more expenses. More optimized practices mean more value. I wagered, for many of years, or not wagers, but advised clients for many years, you should never build a practice less than 5 ops. You'll outgrow it. Everybody knows that 20, 25, 30% of the business at a minimum should be preventative, right? Hygiene driven. So to service an active patient base of 1,800 to 2,000 patients, you need 2, maybe 3 hygienists. Well, you got 2 ops full, doctor can work out of 2. Where are you going to put the walk-in, the emergency, all that stuff? So, a 5 to 7 operatory office, early on in my career, we looked at as a function of number of rooms, right? Well, as things grew and you looked at that and real estate became more expensive and this, that, and the other, it's not really operatories, it's appointments. So if you've got a practice that's open 9 to 4, Monday through Thursday, right? Well, how many more appointments can you put in there in that same facility? The beauty of dentistry is that, 80% of the costs on a P&L in dentistry are fixed, and I'm lying low there. Clinical variable costs, national average for lab and supplies, are something like 15%. A little higher for implant-driven practices, a little higher for clear aligner-driven practices. But in theory, every dollar you can do more in that facility, or every appointment you can schedule in that facility, yields 85 cents to the bottom line. So, I would say rather than focusing on, there's nothing wrong with planting a flag in an area that you feel has a community that you want to serve, right? Whether it's a growing suburban community or an urban community that you want to live in. But more practices doesn't necessarily mean more value. That's thing one. Thing two is, if you just look at the time horizon, if the end goal is to take on a strategic partner or a financial partner, by financial partner, I would mean a fund or a private equity fund. The average general dentist in the United States does something like 798,000 in collections. That's as of 2022. My numbers are maybe dated there, but it's not 1 million. In fact, less than, I think I could be misquoting this, but I want to say less than 15% of practices do over 1 million, and less than 5% of practices do over like 2.5 million. It's something like that gradient, shall we say. So, the more that you can, collect or produce or service, be it extended hours or more operatories out of one facility, in theory, the more effective you are. Well, from an overall EBITDA margin, the average margin, EBITDA margin on the sample set of something like 4,000 prospectuses through PTS is about 15.7%. Now that's for a GP practice. So a PE fund isn't going to invest in a platform, if you call it, unless you're approaching or at or over the 8-figure in EBITDA mark. So we're talking, 10 million of EBITDA. That's investable from a fund standpoint. From a strategic partner standpoint, what ultimately most strategic partners already have all of those admin services in place, right? Revenue cycle, finance, accounting, they're already negotiating with insurance companies, legal, payroll, all that stuff. So the more that you try and build on your own, if you end up going the strategic partner route, well, a strategic partner really doesn't need those things, right? Even though you're already doing that. So, if someone does want to have multiple practices, be it forever or for 10 years or for 5 years working towards an end goal, my advice would be make sure that you have dental specific expert advisors. You need a great CPA. You need to know what your business is worth all along. Through PTS, our evaluation process is all pro bono. We'll dig in deep dive to give somebody the advice that they need because we want to be correct, right? It's hard for us to give the correct advice without looking under the hood on financials. So, it's a little bit of paperwork and time and effort, but a lot of value in understanding kind of where you're at. So that would be my advice there. Surround yourself with really good advisors, be it either in M&A or in the CPA realm.
Yeah, just like the DSO groups, there's good advisories and bad advisories. What you don't want to do is get hooked up with a bad advisory. So I would just encourage any doctors considering that, just do your research on whatever advisory firm that you do choose.
Yeah, and and that might be a good spot where we may have to do part 2 of this at some point because I could talk to you guys about this all day.
Ty and I'll go all day if you let us. It's a real curse. I can assure you. At some point, you got to just tell us to shut up.
But it's just, I'm telling you, it's interesting. And I talk to these practices all the time, and everybody's in some version of that. Even if they're going to be in private practice forever, they're cognizant of this. They have questions about it. It's a big part of all of our lives here. And so it's just wonderful to get perspective on it. And so who knows, maybe we'll do another one of these. We'll definitely get some follow-up for everybody. And I think, let me just get your guys' contact information up here for everybody who's on here. And did you guys want to give some offer to the folks who are listening as well?
Yeah. We so PTS will do. If you reach out to, probably the easiest way, just shoot both Matt and I an email with your interest. But we're offering a pro bono practice valuation to everyone on the call. And what that is, it's a 15 to 20 page document underwritten by a dental CPA. This is a legal document that can be used in a trust or a will, and it's yours to keep, whether you decide to do business with us or not down the road. So a lot of value for a small investment of your time, and probably take you, 2 or 3 hours to get the info together. Big return on investment for your time because you get a bird's eye view of how private equity would view your practice as an investment. We value it both as if you were to sell it to another doctor, and then we estimate what a private equity backed group could bring to the table. So I think it's very useful information, and it's not information that your accountant can give you. There's a big difference in evaluation versus a P&L. So we're happy to offer that to anyone on the call here. Just email Matt and I, and we will start working with you.
Wow, that's fantastic, and great value there for an offer. And let me put my information up here too. Look, everybody's in a different spot. I'm sure the viewers and listeners here. And once you get that valuation, or if you determine you're in a different part of your career, whatever it is, we can give you an evaluation from a marketing standpoint as well, and sort of give you your top 10 numbers and go through that. There's no charge for that either. Or we can just answer questions and get you to the right people. So you don't have to be a T&T customer to contact us for help. So we appreciate everybody's time today. Matt and Ty, you guys are just a wealth of info, and very appreciate the fact that you'll give us some of that. And as far as I know, you're not charging me, so I appreciate that very much. That was just free advice that I could get right there. So thank you to everybody who showed up today. We'll have a recording of this if you want to be able to go through it. There's a lot of info, and we'll follow up with everybody and have a wonderful rest of your week.
Sounds great. Thank you all.
Thanks, Tim. Appreciate you.
Bet.